guy, the CEO of the Nth Degree, refers to himself as a non-boring finance guy. I'm excited for this. Financial certainty. He is going to show us how we're going to gain financial certainty. Dan Nicholson, welcome to the stage.
Hey guys. Yeah, thanks so much for having me. I guess give me a thumbs up. Can you guys hear me okay, or in the chat? Super excited to be here. I guess first off, when somebody hears CPA, that invokes a certain feeling. So I know everyone who's here, close your eyes for a moment, take a deep breath. It's going to be okay. I'm not going to talk a lot about the IRS and a bunch of things that kind of trigger us. I want to talk to you specifically about financial certainty, and I want to give you a little bit of context first and foremost. So over the last 10 years or so, I've had somewhere north of 3,000 unique conversations with business owners, type A folks who are quote unquote high net worth. And I want to share with you the universal problem. What is the universal problem I've been asked to solve across those 3,000 plus conversations? And the question that I get asked, and it comes in various different shapes and forms, the way that they specifically articulate it, but it's some version of, am I going to be okay? Am I going to run out of money? And that's both from people who are just getting going and those folks that have already kind of made it. It's hard to relate to the person who's maybe already made it, but it's called Parkinson's law. More money, more problems. As you make more, you spend more. Your lifestyle expands based off your income. And so there's still sort of this, am I going to be okay question that people are asking. And so ultimately, that kind of boils down to, I believe, one word, which is uncertainty. Okay. So, and an equation that I learned a couple years ago from this guy, Chip Conley, who kind of synthesized perfectly for me the way that I've been trying to work with clients over the years. And it's this equation: anxiety equals uncertainty times powerlessness. So anxiety equals uncertainty times powerlessness. And it's a multiplication. It's not an addition, meaning that they both amplify each other, right? And so that was sort of this aha moment, because I had been trying to help people solve financial uncertainty, and hearing that equation helped me distill it down. I think it's called the distributive property. I think I learned that in second or third grade math, where I can take that equation and add financial to it. So financial anxiety, that sort of question of, am I going to be okay? Am I going to run out of money? Equals financial uncertainty times financial powerlessness. So if we want to get rid of the financial anxiety that we feel, we have to drive up our certainty, right? And we need to increase the amount of power that we have over our finances, okay? If we want to have less financial anxiety, we need less uncertainty, and we need more power over our finances. It's really that simple. So how do we go about doing that? Well, I spent the last decade plus, really the last 20 years, trying to develop an operating system for how to create sustained financial certainty. I started my career, just sort of quick backdrop, I was that cliche kid growing up scheming on business ideas. I got an accounting degree and an information systems degree because I thought the combination of the two would be the best skill set to be an entrepreneur. And then I went the furthest that you can possibly go from being an entrepreneur, in my opinion, which is I did a fellowship at the board that writes all the accounting standards in the US, sort of like the equivalent of the Supreme Court for accounting. And I can tell you that that's really, truly the least entrepreneurial space that you can go in. But that put my whole career down an interesting path for a while, because the accounting standard I worked on was a derivatives and hedge accounting standard. Some of you have probably heard about hedge funds in the news recently with what was going on with GameStop. So that put my career down this whole interesting path, or just direction away from entrepreneurship. And then I woke up one day and was, what am I doing? I'm really working in the space that's not at all entrepreneurial. It's really just numbers, and it's pretty arbitrary, and derivatives, hedging is really arbitrary space. What am I doing? And I realized, hey, there's an opportunity to do something different in the accounting space, which is help what I call purpose-driven entrepreneurs, folks who want more than just money. They want to change their legacy, answer or solve this equation around financial uncertainty. So I developed an operating system, and kind of leveraging my research background from the time I was at the board, I've accumulated a fair amount of data that supports this operating system. Okay, so with that, I want to share with you the sort of misconceptions or the traps that we set ourselves in that causes increased uncertainty and less power over our finances. First off, this is what we think is going to happen over time. We think we're going to start a business and miraculously cash flow is just going to keep going up and up. It almost is reinforced by the hustle mentality. If I just keep working harder and harder, I'm going to make more, right? Now, if you've been running a business for a while, you know what actually happens is that cash is all over the place. All of a sudden, we get started and we are bringing on more clients and everything looks great. And we start telling our spouse or our friends, like, oh, I'm killing it. Maybe we share some Stripe screenshots and everything's awesome. I'm killing it. And then all of a sudden, what happens? A couple months later, you're out of cash. Now you're scrambling, or maybe you're even in debt. And then you kind of reset and you reshuffle. And now, okay, things are great. And then, oh, now it's even worse than before. So what is the thing that's really going on? Well, the thing that is going up and up for most business owners is risk. In order for them to grow their cash flow, they're taking on more and more and more risk. And it shows up in these nefarious ways. It shows up in the sleepless nights and the volatility in your cash flow and all the ups and downs. And so we need to make sure that we first understand what cash flow actually is and understand what risk actually is. Believe it or not, in these 3,000 plus conversations that I've had, many people do not actually know what cash flow is, and they don't really understand risk, which is why they find themselves in this experience to begin with. All right, so what exactly is cash flow? Okay, is it revenue and sales? Is it profits? Is it your bank balances? What is it? Now, many of us think it's revenue. More revenue means I'm going to have more cash. More profits means I'm going to have more cash. Okay. Well, again, I can tell you that's not necessarily the case. So let me give you an example. This is just an example. Q1, quarter one of this company, they had revenues, 75,000 in January, 80,000 in February, 85,000 in March. So if you're an internet marketer, you're posting all your screenshots, hey, everything is awesome. My revenue keeps going up and up and up. I must be killing it. Well, if you look closer, their cost of sales is kind of all over the place. So even though revenue went up in February, their gross margin went down. And then March it rebounded, but not much more than what was in January. Ultimately, though, in this example, when we get down to net profit, we show an upward trend line. So profits, revenues are going up, profits are going up, must mean that we're killing it. We must be Scrooge McDucking it through some gold coins right now because revenue is up and net profit is up. But let's take a closer look now at their balance sheet. Now, the balance sheet is the most important financial statement, okay? If you talk to your accountant, you talk to your CFO, whomever, and you ask them what's the most important financial statement, and they say anything other than the balance sheet, you need to find somebody else, you need to hire somebody new. Because your P&L, profit and loss statement that I just showed you, your statement of cash flows are all based off this balance sheet. So if this balance sheet is wrong, your other financial statements are going to be wrong. So if we take a look here in this example, same company where revenue was going up and profits went up over the quarter, that they're actually in a situation where cash went down. That first line item at the top, 50,000, 45,000, 35,000. Well, how is that possible? Well, they bought other stuff, other assets. So they bought maybe more inventory, as an example. Maybe they bought a car or invested in some equipment. Could be any number of things that went into this other assets line. But cash actually went down. So this company that grew revenues and grew profits is actually, at the end of the quarter, in a worse off cash position. Now, I call this the highest month paradigm. And what I see, again, and I'm a data-driven person, I've looked at thousands of businesses over the last 20 years, researcher at heart, is that I coined this term, the highest month paradigm, which I'm the most concerned about entrepreneurs when they hit their highest month in sales, and especially if that highest month represents a milestone. for them, where they look at it and they multiply it by 12 and they go, oh, I'm on a 7-figure run rate, or I'm on an 8-figure run rate. They've now anchored themselves to this idea that they're an 8-figure or 7-figure business, and they do everything they possibly can to ensure that that happens. Oh, I got to scale my business now. And so in the 3 months after they hit their highest month, they take on the most amount of risk because they think they have to scale their business. So they go out and they buy a bunch of stuff, they hire a bunch of employees. But the data doesn't actually indicate, per se, that they are a 7 or 8-figure business. They just had 1 month that was the case, right? So we have to be really careful and understand the trends, the rhythm of our business. Was this a seasonal trend? Was this, maybe I was on a podcast 3 months before, and now the podcast has been launched, and now the reason why I had my highest month is because a bunch of listeners of that podcast bought our stuff. So we're not actually on a trend of growth unless we're doing similar podcasts consistently. We had a one-time highest month. But if we don't understand our trends and the data, we end up making these decisions, or we end up worse off. We took on more risks. Okay. So moving on, the moral of the story is that cash flow is not sales. It's not profits. It's a function of the changes in your assets and liabilities. So you have to, in equity, so you have to look at your balance sheet and understand those accounts and what they mean. Because revenue, again, might be going up, profits might be going up, but you might be spending it. You might be taking on more debt, buying more assets because you think, oh, I have to do this to scale my business. That's how we end up with all this volatility over time. So that's cash flow. Now let's talk about risk for a moment. Risk, in the most simplest terms, is the possibility that something bad will happen. Now we can take that and we can break it into different buckets: investment risk, business risk, environmental risk, health risk, security risk, so on and so forth. We need to understand all the risks that we face. I take clients to this exercise. Year before last, I built this program on how to recession-proof your business. Had a bunch of people who got really offended that I even mentioned the idea of a recession, because at the time, this was pre-COVID and the economy looked great. But it's not about me saying, oh, we're in a recession. It's about me saying, what are the fundamentals that we need to have in place to make sure that our business can sustain ups and downs, okay? And so one of the risks is, what if something bad happens? But also some of the risks are, what if best case happens, right? What if we hit all of our metrics? How are we going to handle that? Are we in a position, if we onboard a bunch of clients, to be able to hire more staff, right? So there are downside risks. There are also upside risks that we need to be mindful of. Okay, so that's risk. And how can we go about identifying those risks? Well, I have something I call the CASE framework. CASE is a cheesy acronym for compile, analyze, strategize, and execute. And what I find that most entrepreneurs do is they either just strategize, or they wake up Monday morning and they've got a ton of ideas because they took some time off for the weekend. And so they spend half the day just like brainstorming, writing out all these strategies that they have, and then they don't do anything with it. Or they execute. There's a problem, it's in your face, there's a fire, and you just go and solve it, or try and solve it. The problem is that you have to compile first, get all the data, and then analyze what the data tells you before you strategize, before you execute. The analogy that always comes to mind is Google Maps, right? Google Maps only gives you the correct course for you to drive if you give it the correct current location and the correct final destination. So once you enter in the correct current location and the correct final destination, and you see how long it's going to take, then you can strategize and go, okay, it says it's going to take us 10 hours. What can we do to make it 8? We're going to drive faster. We're going to take these shortcuts. We're not going to take any breaks. Right? But you first have to compile and analyze what you see to come up with the right strategies and then execute. So the same is true when we're talking about risks. We've got to compile, identify all of them. What do the risks tell us about our business? How do we hedge or eliminate them? And then we execute and close the holes, okay? This is all part of just a broader understanding of uncertainty and getting more power over your finances. Moving along though. See if I can get the slides to advance. Sorry, there's a little bit of a delay in. Okay, so now that we understand cash, now that we understand risk, and we understand this paradigm that many people get themselves in, which is they think the cash is just going to keep going up over time. In other words, if I just keep working at it, put more effort in, but as if cash is somehow a function of effort and time. It's not necessarily. Sometimes it is, but it's not necessarily. So now that we understand what cash flow is, and we understand what risks are, we need to build out an operating system where we systematically drive down uncertainty and increase our power. So I built this operating system. It's part of this broader thing that I call cash flow engineering. But there's two pieces to it. There's what I call the 4 commandments, and then there are which are kind of the base assumptions that go into an operating system, and then there are the actual frames, issue processors, principles of how do we actually navigate through specific problems. So we have a base set of commandments, assumptions, and then we have tools to process those issues. So I've only got time today to just take you through those commandments. So commandment number 1 is that we must bias, closer over more. So I've studied this pretty extensively. I've talked with folks like Dr. Jeff Spencer, who's worked with some of the most preeminent people in the world, U2, Bono, Tiger Woods, Lance Armstrong, 40, 50 Olympians, so on and so forth. He's observed the same paradigm. We think that more is the answer to solving all of our financial problems. More clients, more employees, more revenue is the solution. More is the solution. Sometimes more could be the worst possible thing that you could implement. As I mentioned, Dr. Jeff, he's observed in really high achievers that when they hit their peak, when they just had their biggest event ever, that now's not the time to double down, because our risk back to the highest mode paradigm is probably the highest. So rather than doubling down and trying to take on even more, we might want to take a pause. Okay. So we got to bias closer meaning what are the things that we actually want? Okay. I mentioned I work with purpose-driven entrepreneurs. Your business exists to serve you, is my belief. And so if your business is built to serve you, what are you trying to get closer to? I come back to this in almost every business decision that I try and make, which is what am I trying to get closer to? Because if I just assume more is the answer, I might get further away from the thing that I want. For example, if the number one thing I want from my business is more time, I want more time, that's my number one priority. Well, there's a cost to having more time. Say it's 10 more hours per week. There's a cost to that. Now, if I just assume more is the answer and I go out and hire some people, I'm probably going to be worse off, right? Taking this from the Intel CEO, and he found that every direct report is going to, on average, require 4 hours of time from you per week. So in the short term, if your number one thing is that you want more time and you go out and hire 4 people that are going to directly report to you, you're going to have training time, and then you're going to have, after you get past the training, which is going to take up a bunch of your effort, then you're going to still have the management of that staff, right? The 4 hours plus per week of your direct reports. So if your number one thing that you're trying to buy is more time, and you assume more clients or more employees is going to be the answer, you may have gotten further away. You actually just added more risk to your business to getting you closer to the things that you want. So you have to actually understand, what is it that you want? I built a whole methodology on this. I built an app called the Certainty app, where we actually go through and we map out, we call your profit priorities, the things that you want to fund. And we put them in order. 1, 2, 3, 4, 5, 6, whatever there are. We put them in order. Okay. It took me a long time to figure this out because I come from a conventional finance background. And it took me a long time to realize that those tools don't work for small business. Okay. I'll tell you what I mean by that. If you're working for a Fortune 500 company, you have one job: maximize shareholder value. The CEO has a fiduciary responsibility, maximize shareholder value. Okay, what does maximize mean? The most, more, maximize more, most amount of staff, most amount of employees, most amount of so on and so forth. Because you can't try and prioritize the business based off each individual's shareholders' wants and desires, because there are thousands, hundreds of thousands, maybe millions of shareholders. So you can't ask them what they want. But when you're a closely held business and team of one or a few owners, guess what? The business exists to serve you. So instead of maximizing, you need to optimize. What is the most efficient path forward towards the things that you want, right? Most efficient path forward to things you want, which means we have to actually list them out in order. And because we can't maximize, we have to do and try and have everything. We have to optimize, and we work down the list. Let's start with number one. How do we get closer to number one? What's the most efficient path? Fund that, then move to the second thing, then the third. The biggest trap that I see folks getting in that drives down their profitability, creates all the cash flow volatility, is that they're trying to do all of it. They're trying to fund everything now. You don't have an infinite amount of resources. Every decision is a trade-off. Let's optimize towards the number one thing that you want. So we have to bias closer over more. When you get stuck in, I don't know what to do next. Should I hire? Should I not? Should I invest in marketing? So on and so forth. What are we trying to get closer to? Which leads me to the second commandment. We have to understand the difference between preference and binary. Almost every decision that you're faced with in your business is a preference. Believe it or not, you don't have to grow your business. You don't have to bring on another client. You don't have to hire another person. It's preference. That's why you can't just go on Google and say, should I grow my business? And type that in and get an answer that's actually going to work for you. This is the other trap that folks get in, is that they try and take a binary approach to their finance. They build out all these elaborate spreadsheets, key performance indicators. They don't really tell them anything. They're trying to apply a maximize framework to their situation. And it ends up getting them further away. You have to understand that the questions that you're asking about your business, about your finances, are preferences, right? Which means you have to actually sequence out the things that you want, put them in order, make it a solvable equation. If we take all your preferences, all the things that you want, more time, pay off debt, fund reserves, fund legacy. We take all those, your vision board, and we put a date and a dollar amount, and we look at your current cash flow and your current assets. Guess what? We can actually calculate how much more you need to make to fund all those priorities. And then every action we take is to close the gap, shrink the gap in how much cash flow we need to fund all of our priorities. But you have to understand their preferences. You can't get stuck in the binary mode, but there is somehow a right or wrong. Next critical assumption commandment is that every business decision is a financial decision. This is probably the thing that irritates me the most, which is I get on these conversations with folks and they say, hey, I don't want to have anything to do with my finances. I want someone to take care of it. And I just want to focus on sales. Well, guess what? Sales is a deposit into your bank account, right? Which means it's financial. Every decision that you're making is financial. You can't somehow separate marketing and operations and IT and all these other things. You can't separate that from finance. Every business decision is a financial decision. That's why if you look at it, there's a surprising number of Fortune 500 CEOs who have accounting degrees, right? Because they understand that the combination or the intersection between strategy and the fact that the strategy has a direct implication on our finances. So you can't separate them. If you're in the narrative of, oh, I just don't want to deal with finance, I don't want to look at it, someone else is going to take care of it, I'm going to outsource that, my time's too valuable, you're in the trap where you're going to be riding the roller coaster. So every business decision is a financial decision. And then lastly, and perhaps most importantly, assumption commandment number 4, business is gambling. You're making a series of bets. Every bet we make must be an asymmetric bet to the upside. Asymmetric bet to the upside means I'm going to invest $1 with the potential to get $50 back or $100 back. Right? So the upside is substantially greater than the downside. Let me tell you again from the data and the folks that I've worked with over the years is that most bets that entrepreneurs are making, the downside is significantly greater than the upside. It's the burn the boats approach. I'm going to go all in and I'm either going to be bankrupt or I'm going to make $100,000 or homeless and $100,000. So, okay. Bankrupt, homeless, that downside risk, much more significant in my opinion than making $100,000. Or they make a bet where the downside and the upside are equal. I'm going to spend $1 to make $2 back, but I might lose that dollar. Okay, money is not infinite. Every decision that we make has a trade-off, has an opportunity cost. If you invest your money in opportunity number one, you now have that tied up in your resources where you cannot invest in opportunity number 2, 3, 4, 5, etc. So you have to have a process system to be able to evaluate your opportunities and determine whether or not you're making a bet that's actually asymmetric. With that, I was going to open it up and see if there's any questions before I, so I don't know if Tab is around, anyone else? See
no,
if
you
there's
get me. You get me. Tab doesn't want to come up. He's experiencing some nerves right now. We have Joe that says you talk about risk and the different buckets of risk, but how do you put a metric to risk and what are risk metrics?
Yeah, really great question. So I got this whole methodology I call alluded to. I call it cash flow engineering, and it's about systematically evaluating your cash flow and trying to get what I call metadata, data about your data. And the way that I do it is I look at and I think about each business has their own rhythm. Okay, and we can break that rhythm into 3 buckets. Is it a industry rhythm? Is it a business decision rhythm, or is it a personal you as the leader rhythm? If it's a industry rhythm, I run one of my businesses is a CPA firm. CPA firm industry, we have tax deadlines, right? March 15th, April 15th, so on and so forth. Consequently, after we get past April 15th, May and June tend to be slow sales, new sales periods for us because people have fatigue from dealing with their accounting. They want to take a little bit of a break. They don't necessarily want to jump in and hire someone new for the most part. I can't fight against the industry rhythm. I just need to acknowledge that exists and shape my business around those specific industry specific rhythms. Every system is perfectly designed to create the outcome that is generated. Biggest mistake that business owners make is that they try and fight against industry rhythms, things they can't change. Rather than fight against it, rig the game to win. Make sure you're putting the right inputs into the system to produce the outcome that you want. Okay, so we have to understand bucket number 1, industry rhythm. What are the business decisions, things that I've implemented that are opposing or going against industry rhythms? Bucket number 2, business decisions. These are things like the payment terms that I give clients. Maybe I collect credit card instead of ACH. So I get paid faster, but then I have a higher risk of somebody refunding later, charging back. Maybe I decide that we're going to close the office the last week of the year. So there are business decisions that I'm making that produce risks. Those are changeable. We can change those business decisions. We want to compile, analyze, strategize, execute, figure out what are all the business decisions that are creating risk. Those are changeable. And then the last one is the personal rhythm, the things that you're doing. Closely held business, you, or if you have partners, your day-to-day mood, how you're feeling can create volatility. So I often give the example that I'm not allowed to change anything in my business in the month of January because I'm grumpy. We're at the start of the new year. We're waiting on engagement letters to get signed. We're going to pay out bonuses. And so I'm just grumpier. That's a personal rhythm every January. And so consequently, I can't make, a rule that I've set for myself is I don't change anything during that period of time. So what I do, compile, analyze, strategize, execute, is I take the last 12 months, just give you a really practical example. Take the last 12 months of your profit and loss statement. Run it by week, okay? Run it by week, last 12 months, profit and loss. Look at the bottom. Look at all of the weeks where you have a negative number, meaning you took a loss for that. And if you just change all those negatives to zeros, so rather than losing, you just broke even. So replace all the negatives first to zeros. Sum that up. More than 80% of the time, people would double their profits if we just got rid of the losses, right? So look at it and see the trend and how much, if I could just change that loss to a break even, how would that impact my profit? Then go through and assign, was that week something I was fighting against industry rhythm? Was it based off a business decision, or is it based off a personal rhythm? It was grumpy, okay? And then from there, you can back into what the strategy is to eliminate those risks that are causing those losses. Then we can get it to zero. Once we get it to zero, then we can figure out how do we really grow this from there. So hopefully that helped.
All right, it does. It definitely does. We have about 2.5 minutes left. We have one more question. It's from Alan. He says, my business partner and I recently discovered just how little we know about finances and accounting. What books, podcasts, videos, or etc. would you recommend we check out to have a more solid knowledge?
Oh man, I'm super biased here. So I have a whole program called Certainty U where we teach people how to think about finance in a different way. The reality is finance, like everything in business and life, is behavior-based. Take a look at the tax code. In particular, U.S. tax code, it's behavior-based. Right? If you want to pay 0 to 20% like investors pay, or 25% or less like big corporations pay, instead of the 30 to 50% or 40 to 60% that individuals and small business owners are paying, you have to change your behavior. Behave more like an investor, behave more like a big corporation. Same thing here. We have to change our behavior in general with our finances and stop trying to maximize and move towards optimizing. Make sure the business exists to serve you. Otherwise, what's the point? So Certainty U, CFEclass.com is where I teach a lot of this stuff. I would start, though, if you don't want to look at my material, I would start with How to Fly a Horse. It's not a specific finance book, but it will change your thinking about the way that problems are really solved. Because most of the things in finance are counterintuitive. I think that might be my time.
Hey, Dan, it's Tab. I regained my nerves. As Ruben was trying to be funny with. Hey, thank you so much, Dan. I appreciate you. Can we give it up? Just big thanks to Dan. Thank you, sir. And we'll be talking soon, man.
Welcome to Refiners. Refiners is an organization of business owners and business professionals that are looking to improve their business and personal performance, just like you. As a Refiners member, you will have the opportunity to build connections with like-minded individuals from your industry. Join our amazing community for free at refiners.io.